Michael, thank you very much for joining us today. The last time we spoke, the big news was the Fed cutting interest rates. But this week, it's all about China and the People's Bank of China cutting interest rates and also implementing a massive stimulus package, which can be described as historical just in terms of size and breadth. And just to recap, some of the changes, interest rates were reduced to 1.5%. Interest rates on $5 trillion in mortgages was also lowered. Required reserve ratio for banks was lowered with the hopes of freeing up money for lending. And you have said in the past that the most important central bank for understanding what's really happening in the real economy is the People's Bank of China. What's your take on all these policy changes we've seen in the last few days?
Well, hi James, great to be on again. I think the main thing is that what you saw out of a lot of commentators was basically a more hysterical reaction rather than a historical reaction to what China's been doing. And I think the reality is that given the whole nature of the Chinese financial system and the fact that it's run by the state and we've got state regulation and state control of banks, etc., it's extremely difficult to make any sense of or projections from these particular announcements. I mean, they're pointing in a direction that's without any question at all. The Chinese authorities are trying to ease, but by shifting interest rates down a few tens of basis points, that ain't going to do it. The whole the necessary fact in the Chinese financial system is they need a lot more liquidity. The system has been starved of liquidity pretty much for the last 2 to 3 years, which is largely why the Chinese economy has never managed to escape from the COVID lockdowns. They've been forced to run a tight monetary policy to protect what has been a weak yuan currency. And, these measures are not going to do it. They're not really going to move the needle unless they start to inject sizable amounts of liquidity into the markets. Now, can we infer that from the statement that's come out? Answer no, quite simply not. We won't know that for several months. But what we've got to do is to keep monitoring the money markets to see whether the People's Bank of China is injecting sizable amounts of liquidity into the system. And we've got to monitor the state-owned banks to see if their lending starts to increase sizably. And those are really the key gauges to watch. It's not about looking at short-term interest rates. That's not that's not how the Chinese financial system operates.
Very interesting points. The People's Bank of China also pledged $113 billion to provide equity market support. That equates to about 1.8% of the market cap of the Shanghai Composite Index. And this is very reminiscent of what the Fed did in 08, 09. What are your thoughts on these changes?
Well, I mean, to come back to the point, I mean, at the end of the day, they're moving in the right direction. But is this the equivalent of a TARP or what went on in 2008 in the US? Not yet. If you recall, back in 2008, we had a simultaneous, massive fiscal stimulus which underwrote the banking system, and we also had the Federal Reserve that was very accommodative. The Federal Reserve was pushing much larger amounts of money into an equivalent size financial system at the time. The PBOC is not doing that yet, but watch this space. It may well emerge over coming days or coming weeks. And as I said, looking at this particular package, it doesn't have the magnitude. It may have the direction, but it doesn't have the magnitude yet really to solve the problem. We're talking, for example, if you sort of scratch around at the numbers, maybe the Chinese have released or injected something like 1 trillion yuan into their financial system. To solve this problem, we're talking about several trillion yuan and probably nearing $1 trillion US before we start to get any traction in terms of resolving their problems. China has a big problem. There's no question about that. Everybody understands that, I think, now. You've got a structural problem with what I've called red capitalism. In other words, red capitalism cannot survive without the West accommodating it. And the West is now sort of closing the doors to some extent to make it a lot more difficult for China to export. And that clearly is a long-term constraint. But they've also got cyclical problems. And it's the cyclical problems which these particular issues are trying to address, or these policies are trying to address. And that really comes back to the fact that if you look at the Chinese economy and financial system, fundamentally, the problem is that the real exchange rate, in other words, the exchange rate adjusted for inflation, is way too high. It was exactly the same problem that Japan had at the end of the 80s. It was the problem a lot of the Asian economies had back in the late 1990s. And it's the problem that China's got now. And you can resolve that that problem in two ways. You can basically let your asset prices and your high street prices deflate massively, but that pushes a huge burden on the domestic populace, particularly the poor who have to, basically fighting falling incomes. Um, or you allow your exchange rate to devalue. And at the moment, China is using the yuan, the Chinese currency, as a marker of soft power, and it doesn't want to lose face by allowing the yuan to devalue. But at the end of the day, they either stop producing or massively overproducing goods, or they let their currency drop. And we're just, I suppose, debating now which of those two things will happen. And it's more likely in the long term that the exchange rate will have to fall in some way.
And I know we never really know what's going on in China, but because they announced so many changes all at once, do you think things are significantly worse there than we're led to believe or what we might think?
Well, I think they've got as I said, they've got a problem. I mean, the scale of the measures that have been announced are not sufficient to cure that problem yet. So they haven't, they're not throwing the kitchen sink at the problem. That's for sure. I think what they're trying to do is, in sort of typical bureaucrat fashion, they're sort of fiddling at several knobs without sort of realizing maybe the magnitude of what they're trying to address. But I think ultimately what we need to look for is whether they inject substantial liquidity in markets over the course of the next few months. I mean, I'm talking here of maybe period through end year. We'll get a better gauge as to whether China is able and willing to ease its monetary policy. And as I come back to the fact, I mean, the Chinese financial system is very different from the US financial system or the Western financial systems insofar as interest rates play a secondary role there. They'd like interest rates to play a bigger role, but they don't. The fact is that what you've got is effectively a state allocation of credit system, rather like Japan in the 1980s, which was then called window guidance. China is following a very similar remit. And what's happening is that the PBOC injects liquidity into the money markets. The shadow banking system, which shadow banks are not quite like what we understand in the West. Shadow banks are actually the traditional high street banks in China, but they're operating off balance sheet in many cases. They will get extra funding from that pool, and they will lend. And traditionally, they've lent on real estate, particularly to the local authorities. Now that has been looked down badly upon in the last few years, and it's a question about what they'll do in the future. But that's a very good way of actually reviving the economic system if you let the shadow banks start to lend again. And then you've got the state-owned banks, and they will be given directives by the People's Bank in terms of lending more money to certain industry groups. Now, what we rather hope is that it doesn't go down the route of solar panels or electric cars, because we've already got way too many of those. But you kind of see the problem. I mean, that's their structural issues. But in terms of addressing the business cycle in China, they need to get growth up. And the easiest way to do that is to try and inject more credit. Now, you will argue against me and say, well, okay, isn't that creating more debt and it's compounding the problems? And I'll come quietly and say, well, yes, probably it is. But try telling politicians that, because they've got the immediacy of trying to revive the Chinese economy, and there aren't many other ways to do it.
So they cut by 20 basis points. And to your point, that's not much. But are you
It did.
suggesting that even if they cut by 50 or 75 basis points, it wouldn't have any bearing on the economy?
Yeah, because it's not, I mean, financial systems, well, particularly in China, but even globally now, don't really operate around interest rates. They operate around the volumes of liquidity, and that's really the main thing to watch. China is a clear case in point, because interest rates don't really matter. It's much more about the decisions that policymakers make about allocating credit to certain industries, and that's how the Chinese economy tends to work. Now, let me say that that's actually an important factor. If the People's Bank decides to goose the economy by increasing liquidity significantly to certain industries, then you will get a rise in Chinese business activity that will spill over, given the huge size of the Chinese economy in terms of the world economy. China's footprint, we know industrial footprint is vast, and that will have a very positive effect on world commodity prices. There's no question about that. But what we've got to see is evidence that that's happening first. I would suspect it probably will. That's my hunch, but I'm not convinced because I haven't seen the evidence in front of me yet, and that may take some months to come out.
You touched on the real estate market a couple of times, and I read an article recently which stated that 34 of China's top 50 property developers have defaulted on their debts in 2024. And many of China's largest property developers have gone bankrupt in recent years. One of the big ones this year was Evergrande Group, one of the largest developers in the world. And I wonder what the ramifications are to the wealth effect of a collapsing real estate market in China.
Well, I mean, the plain fact is it's significant. I mean, I'm not going to sit here and say that this is a bullish move. It clearly isn't. If you're getting declining asset prices, it's clearly very negative. It has a bad effect on the economy, has a bad effect on wealth levels. But that's one of the things, after all, that I would imagine the Chinese authorities are trying to address. You cannot have an environment where you've got falling prices and particularly falling asset prices. It's very negative for the economic backdrop. And that's why I say if you've got a situation where China is massively overproducing goods, the only way that you clear markets is to allow the real exchange rate to devalue significantly. And that's either a question of letting the nominal exchange rate fall, or it's sitting back and watching prices in the high street or prices in asset markets collapse. And up to now, the Chinese have held the yuan up at artificially high levels, I would argue, and they've let prices in the high street and prices in asset markets collapse. And you can't keep doing that because there's only so many punches that the domestic populace can take. And I think China is now realizing that. So at some stage, what they've got to do is either cut back production or boost liquidity significantly and be prepared to take the cost in terms of a lower yuan currency.
So we really have two issues here. I want to get your thoughts on this. We got this collapse in the Chinese real estate market, which is impacting everyone within the country. But then we also have what some are calling the Cold War 2.0. And the relationship between the US and China right now is probably the worst it's been in decades. And so this is impacting exports.
Mhm.
And so, what are your thoughts on this? And I kind of wonder if China, you mentioned this earlier, but is China becoming another Japan where their economy is going to be in the doldrums for 20 or 30 years?
It's entirely possible. I mean, the reality of the worrying reality is that China's just not another Japan, but it's basically another Japan tenfold bigger. And this is the issue we've got to face. So this is a problem not just for China; it's a problem for the world economy, given China's huge industrial footprint. This is a fact. Now, what I'd also do is sort of wearing my maybe earlier Salomon Brothers had. One of the things that Salomon Brothers was used to say was, in financial markets, there are no unrelated events. And let's just try and join up the dots between what America has done with cutting interest rates and what China has done with its easing package. One of the things that maybe leads into this is to evidence what happened at the beginning of August with the jump in the Japanese yen. Now, my long held thesis, and it was completely unproven and I would say 100% speculative, but nonetheless, it seemed to have some merit. And that was to say that if you look back to when the yen collapsed about 2 years ago, the speed or the alacrity with which the yen fell against the US dollar was something I've never seen from a major currency, in 30 years of being in financial markets. Markets don't do this to major currencies, only governments do. So, in my view, that yen collapse was a deliberate move. Coincidentally, perhaps, and this may be, grasping at maybe coincidences or straws. It happened to coincide with the Russian invasion of Ukraine, so maybe there was something there to try and associate that with what was happening in Japan and China. And I think the fall in the yen was all about putting a lot more pressure on the Chinese yuan, trying to force it to devalue, and actually painting the Chinese into a corner and trying to make them tighten monetary policy and ultimately wreck their economy. So I think it was all deliberate. Now, if that's the case, just hold that thought for a moment. Go back to August of this year, and then you see a sudden jump in the Japanese yen in value. Now, that was quite a substantial move. It came out of, well, pretty much out of the blue. And I suspect what happened then was there was some tacit agreement between the US, China, and Japan to basically realign Asian currencies at a new trading range. And this can be drawn as a parallel to what happened maybe in 1985, for those that remember, with the Plaza Accord. And what happened in 1985 was the US dollar was very strong, if you remember, courtesy of a very loose fiscal policy, ditto now, and a very tight monetary policy, ditto now. And what America agreed, alongside its other allies in the then G5 countries, was to basically allow the dollar to devalue by the US easing monetary policy significantly. And that meant that the other countries ultimately could ease their monetary policies in time. And that's exactly what happened. And that big liquidity injection led on to an asset bubble that blew up through 1986 and 1987 and ultimately ended in tears in the October crash of 87. Now, if you look at what's going on now, maybe we're not in size the same magnitude, but I would argue it's the same direction. I think there's been a currency deal done. I think Asian currencies now are a lot more stable against the US dollar. What we've seen is a US easing, and we've seen the Chinese come in and basically suggest that they're going to start easing as well over coming months and a bigger size. So I think this lines up as an equivalent type of deal. And what I would argue is that all this talk about Japan tightening is completely pie in the sky. The Japanese can't tighten. I mean, let's be realistic. They've got a huge debt problem. If they start to raise interest rates, they start to compound the interest bill on Japanese government debt. So dream on, they're not going to tighten. So what you've got is the prospect of liquidity conditions in the global economy moving up still further higher over the next 6 to 12 months. And that's what I would imagine. Will it end in tears like 1987? Well, quite probably. We've seen this script before. But for now, liquidity is going up.
Okay, so I want to spend a few more minutes on this, and because as you mentioned, in the U.S., expansive monetary policy, they have a very aggressive fiscal spending going on right now. That's bullish for the economy, bullish for the markets there. Now we have these policy changes in China. These two countries together represent 45% of the world's GDP. So are you suggesting that this is going to bode well for the global economy?
But in the short term, I think unquestionably, yeah. I think in the medium term, we've still got this long-term bogey of too much debt in the world economy. And that is the problem that is creating instability or fragility in the world financial system. And it's why we're sort of riddled with frequent crises and cycles. It's all about this huge and too big debt load. And the problem is that debt load is getting bigger, not smaller, because governments are now spending a lot of money. They're getting into bigger and bigger fiscal deficit, and they're piling up an even bigger mountain of debt. And that's the problem. And that's why liquidity conditions basically will have to go up in the medium term. And that's why everybody's got to buy more gold. It's as simple as that.
So liquidity is going up. What does this mean for inflation?
Well, I think that let me say first of all that liquidity is going up, which is a monetary inflation. High street inflation, as people understand it, which is basically measured by CPI, consumer price indexes, isn't necessarily going up at the same pace. But the fact is that consumer price inflation, high street inflation, is a cocktail that is made up of several ingredients. One of those is monetary inflation, in other words, the devaluation of the paper dollar. So the more that the Federal Reserve devalues the dollar, you're going to get a spillover potentially into high street inflation. We've actually had monetary inflation, of course, over the last 10, 20 years anyway. I mean, this is the nature of things. The financial system with a big debt load requires liquidity. It requires monetary inflation. Why hasn't that monetary inflation spilled over into the high street? Basically because of two or three things. One is cheap Chinese goods, which have been dumped in the West. Secondly, because of technology gains, which have reduced prices. And thirdly, because oil prices are substantially lower than they were in 2008. And all these ingredients have come through to keep high street prices down. Now, the question to speculate on, is that going to happen in the future? If you've got monetary inflation compounding at a rate of maybe 8 to 10% per annum, which I think is realistic, you will get much faster high street inflation unless you get costs capped in some way. And I'm not that optimistic we will. I don't think we're necessarily going to see 8 to 10% high street inflation, but I do believe we're going to see substantially more than we've recently had. So my figure would be, start thinking of near a 4% CPI inflation, not the 2% that the Federal Reserve claims they've hit in the US. I must say, my personal inflation rate, I don't know about yours, is a lot higher than 2%. So they're fiddling the figures somewhere.
Oh, I agree 100%. Whatever they say, I just double it. Okay. So if they say it's 2%, it's 4%. If it's 3%,
Right.
I think it's 6%. And maybe it's even higher. But
Sure.
So let's talk about this inflation rate. You're thinking it's more like 4%. So as we go into 2025, maybe it's Q1, maybe it's Q2, and let's just assume interest or inflation starts picking up again and starts accelerating. Do you see the threat of interest rates going up in the US?
It's possible. I mean, make no mistake about that. Markets move in cycles. We're now in a situation where rates are coming down. The supertanker is shifting direction, but we know as sure as eggs are eggs, the supertanker will, if I'm not mixing my metaphors, shift direction again. And that is probably an event which may well occur, let's say 12 to 18 months hence, that sort of time frame. Now, it may be that the liquidity cycle turns down before interest rates go up. So we shouldn't be waiting for a tight monetary policy or a tightening monetary policy to, spook us out of markets. I think one's got to be cognizant of the fact that liquidity is an independent cycle to a large extent, and it tends to move in advance of interest rates. Now, I would suspect that the liquidity cycle is likely to peak in late 2025 and come down, and I will argue in a moment why that is. But that liquidity cycle has been basically moving up since October of 2022. And that has really been the mainstay of the bull market in risk assets. And we've been risk on through that period. We continue to be, but we're cognizant of the fact that, we're getting late in the game. We've already had 2 years of pretty decent gains in risk assets. We've got maybe another 12 months to go, but it's going to be harder to make money out of financial assets through that period. Let's be clear. You need to diversify and you need to think about other things, maybe gold or maybe commodities or maybe commodity related equities or this sort of thing. Now, why should the liquidity cycle turn down in late 2025? And I would say there are, broadly speaking, 2 or 3 reasons why that may be the case. One, of course, may be higher interest rates from central banks, but it's the other two which are more important. One of those is a strengthening real economy. So if the world economy picks up, we've got to realize that money can't be in two places at once. If it's in the real economy and fueling spending and increased production, it is not moving around in financial markets. And equally, if it's in financial markets, it's not in the real economy. So financial markets will be crowded out by a stronger world real economy, which is likely, I think, by the back end of next year. But it's the other reason, the third reason, which is really the paramount one to think about. And that comes back to the fact that the whole nature of financial markets has changed in the last few decades. No longer are financial markets mechanisms for raising new capital for new investment in plant and equipment or whatever. The sort of textbook model that drives the business cycle, as as academics tell us, and it's not interest rates that attenuates that particular process. We're in a world where there's a huge amount of debt, and capital markets play the role of debt refinancing mechanisms, not new capital raising mechanisms. In other words, with $350 trillion of debt worldwide, with an average maturity of 5 years, that debt has to be paid back pretty frequently. And on average, it means that $70 trillion has to be repaid or rolled over every year. Now, spoiler alert, debt is never paid back. It's just built up, it piles up. And so you've got a refinance debt basically of a huge amount annually. Now, that 70 trillion is clearly not evenly distributed. Some years you might get 30, some years you might get 70, some years you might get $110 trillion of refinancing. And one of the things that people have noted, as I'm sure you're aware of, is this thing which is basically called, which is about the sort of the debt, the sort of debt wall or whatever it is, or the maturity wall, which is basically talking about how corporations, when interest rates were very low, did a lot of their refinancing, and they basically pushed debt out into 2026 or 2027, and that's when the bulk of it will start to mature, and they've got to face the problem of having not had to refinance very much over the last 2 years. There's a huge amount of debt that needs to be refinanced basically 2 years out. Now, that will start coming into the system or demanding finance sometime around late 2025. And the fact is that if you're going to refinance debt of that magnitude, you need balance sheet capacity to do that. And balance sheet capacity in the financial sector is called liquidity. And therefore, we need lots of liquidity to do that refinancing. So what you've got is a situation which is basically getting dangerous. Number one, interest rates may be going up for inflation fighting reasons or whatever. because of the cycle. Number two, the world real economy could be faster by the back end of next year. And number three, you've got this huge maturity wall in the debt markets to refinance, which will be absorbing liquidity. So the fact of the matter is that debt tends to grow exponentially, but liquidity is cyclical. And you can see from that, from that confluence of different factors, that that's why you get financial crises. Every financial crisis in the last 2 or 3 decades has first and foremost been a debt refinancing crisis. Think of the Asian crisis in 97. Think of 2008. Think of the US repo crisis in 2019. All these were instances of debt refinancing and rollover problems. And we'll get another one, sure as eggs are eggs. But it may be, 12, 18 months away.
And I'm sorry, what was the global debt levels? How much?
$350 trillion.
350 trillion. So that's government debt, that's corporate debt, that's
Correct.
everything.
Correct.
Okay. And so just to bring this closer to home now, the federal debt, let's look at the US, okay? Its debt now stands at $35 trillion. It's growing by $1 trillion every 100 days. The interest expense is $1 trillion. And as you mentioned, that's going to go up in the coming years when they have to refinance at 3, 4, 5%, whatever the number is. So are you suggesting that the Fed is aware of this and therefore, regardless of where inflation is, they're going to start cutting interest rates or be more aggressive cutting interest rates come 2025?
Well, I'd be surprised if they're not aware of it because an awful lot of other people are. The gold market certainly is aware of it because the gold price is going up. And I think if you come back to your metric on US debt has increased by eightfold in size since the year 2000. I mean, that's an astonishing growth rate for debt, public debt. Okay, there are very few assets that have gone up 8 times since 2000. One of those is the price of gold. So gold is matching pretty much exactly the sort of fiscal laxity of the American economy. So the more that politicians kick the can down the road, the more you are sure or certain that the gold price is going to go up. And I would imagine that you've got this debt burden growing, as I said, at a rate of maybe 8 to 10% per annum, which basically would suggest to me that it's going to double, certainly within every 10 years. I mean, that's what the math says. So if you've got a doubling of that debt pile in the next 10 years, you can be pretty sure that the gold price will double because gold is the most wonderful long-term monetary hedge. That's what history has always shown. Now, your question, which is a great question, is the Federal Reserve and the Treasury aware of this? Well, I would argue they are because they're very cognizant of the need for liquidity in markets. One of the things that got very little commentary was the change made, I think it was August 13th, by the Federal Reserve on bank stress test rules. Now, that may be getting into the weeds of this whole thing, but it's very important because basically the banks have been building up huge reserves at the Treasury, in the Federal Reserve, basically to protect themselves because they need to satisfy stress tests their regulator every month. And basically, this money held at the Fed is a pretty decent liquid asset reserve they can post. The Federal Reserve said that actually in future going forward, they can actually use prospective discount window borrowing, also borrowings from federal home loan banks or the standing repo facility as part of their stress test, which means that those reserves, or a large part of those reserves, maybe we think maybe as much as $500 billion, can find their way back into other instruments, for example, treasuries. So what you've got here is the ability to release liquidity, a lot more liquidity into the system, because banks' demand for reserves is actually going to be less. So in other words, the money markets are actually got more liquidity than maybe we previously thought. The second thing that's going on is if the Federal Reserve is kind of doing what I've described as not QE, the US Treasury is doing what I describe as not yield curve controlled yield curve control. It's unconventional, but it's happening. And if you look at what Janet has done at the Treasury since the end of 2022, she's managed to reduce the average tenor of the calendar, in other words, the issuance calendar, the average tenor of bonds offered by 1.2 years, which in fixed income speak is actually quite a big drop in the average maturity of bonds. So they're not funding at the long end, they're funding at the short end. And what's more, bill finance has increased to 22% of total debt outstanding. Now, these are big numbers. And, I think it was Stanley Druckenmiller many months ago who said very perceptively, a lot of these figures are not the statistics you would expect coming out of the US. They're the statistics you would expect coming out of Argentina. Well, actually, no, Argentina is doing a pretty good job at controlling its monetary excesses, and the US is actually going down the old Argentinian path. And the fact is that if you are funding at the short end of the market, in other words, funding through 2-year, 3-year, 5-year bonds, no longer 10 or 20 or 30-year, you are principally selling bonds to credit providers because they like that sort of stuff. And it's a wonderful match for their balance sheets, which are basically getting fueled or pumped up by more and more government spending. So they tend to be the buyers of these bills and these short-dated bonds, not the long-term funds. If the long-term funds bought government debt, that would be pure funding. It would come out of savings. If the banks buy the debt, which is what they've been doing, what you're getting is monetization. And monetization is dangerous because it's monetary inflation. Milton Friedman, for example, the sort of doyen of monetarism, sadly not around anymore, but he'd be turning in his grave looking at these numbers. Something like 3/4 of the increase in US M2 money supply this year has come through monetization of the federal deficit. I mean, these are crazy numbers. It's bound to end badly with higher inflation. Maybe it already is. Maybe we're seeing the inflation and it's not being recorded. And that's really the question to pose. The gold market thinks we're getting inflation for sure. Bitcoin thinks we're getting inflation.
So, okay, so you talked about gold and Bitcoin, and this is how you're suggesting that we protect ourselves in this current environment. Gold's up 25% on the year, Bitcoin's up about 50% on the year, and Bitcoin looks like it's stalled out here. It had a big move back in Q1, I guess, just on the back of the ETF coming to the market. But what are your thoughts on Bitcoin here? Is it going to get going again? Are we close to, I think it's around $65,000, so we're not too far from its all-time high. Do you think it's going to rip going into year end?
Well, wealth warning here. I'm not an expert on Bitcoin, so I'm not going to say very much that's intelligent. All I would say is that the experience that one's had in the last 5 years is that Bitcoin performs rather like digital gold. And to give you some parameters to gauge that off, for every 10% increase in global liquidity, you tend to find a 15% increase in the price of gold bullion. Historically, I'm saying in the last 5 years, Bitcoin has actually produced a multiplier of about 4.5 times. In other words, a 10% increase in liquidity means a 45% increase in the price of Bitcoin. So that explains the Bitcoin outperformance. Will that 45% pertain into the future? Unlikely, because some of that has been sort of take-up effect of a new instrument. So people have been moving into Bitcoin, exaggerating its sensitivity. But I think one can infer in the long term that Bitcoin will at least keep pace with the price of gold, maybe outperform it. And that's how I would tend to believe these things are. I mean, clearly accidents can happen. People may lose confidence in Bitcoin. Something legislation may transpire, which makes it more difficult. But at the end of the day, it's performing like digital gold. And I think one's got to accept that.
And I'm sorry, what is the lag time associated with the multiplier effect?
Well, I mean, it tends to be for Bitcoin. It's actually been it's sort of concertinaed shorter and shorter all the time. And the latest calculations, or what our calculations would say, about 6 weeks. Now, that's in normal asset market reactions, actually a remarkably short time. The fixed income markets normally respond to liquidity after about 6 months. I mean, that's been our normal benchmark. But in actual fact, Bitcoin seems to be a lot more sensitive.
And I want to get your thoughts on why Bitcoin has outperformed gold so much here in recent years. I mean, this year alone, like I said, it's up 50% versus gold, which is up 25%. Last year, Bitcoin was up 150%. Why is gold not significantly higher given everything you just said?
Well, I think gold is the benchmark to think about, and I would I'd venture that gold is likely to move substantially higher. But you've got to remember that we're talking about a rate of growth of liquidity that is already of the magnitude of about 10% per annum. So we're not talking about 30, 40, 50% gains in global liquidity. We're talking about a pretty steady pace here of about 10% increases. Now, the fact is that 10% is not 5%, so 10% is meaningful. And if you've got a multiplier of 1.5 on your gold bullion price, that means you're getting 15% compound out of gold year after year. Now, that's a pretty decent return when you're talking about interest rates at something like 4%, or maybe, if you at a stretch 5%, you start thinking about corporate debt. So broadly speaking, what I would say is that's not a bad return. Now, it may be that Bitcoin surpasses that, and it has done recently, but I think you've got to argue, one has to argue, that part of that is the take-up effect. And, I had an interesting discussion with some academics online yesterday where we were talking about the ingredients or the components of Bitcoin return. And, what we were really talking about was two elements or two moving parts, an intensive margin and an extensive margin. The extensive margin is basically more and more people holding small amounts of Bitcoin. Maybe, a lot of people holding $100 in Bitcoin or whatever, but that number growing from, 10,000 to 100,000 to a million to 10 million or whatever. And that's the extensive margin. But you've also got to factor in the intensive margin, which is saying that $100 could be $200, or if it's an institution, it could go to a million or 10 million or whatever, 50 million bucks in Bitcoin. And I think you've got these two moving parts to think about. So I would argue the intensive margin is something which is sort of playing on in the background and moving rather like an S curve. In other words, the take-up effect, rather like people using the internet or people using mobile phones. More and more people are going to hold a little bit of Bitcoin, and that's going to grow. The intensive margin is basically saying, are institutions using that as a hedge? And I think they are, but it's a little bit like thinking about what's happening with the gold market. What percentage of institutional portfolios are invested in gold at the moment? Now, there are various studies done, and the answers come back at maybe 1 or 2% of total assets are held in gold, which seems a reasonable stab at the number. But if you go back to the 1970s, which I just about remember, in the 1970s, portfolios were vested probably 10%, sometimes 15% in gold. So it was much, much bigger amounts. So I think that what you've got here is the ability for both in Bitcoin, the intensive margin to increase, and in the case of gold and Bitcoin, the extensive margin to increase as inflation worries start to pick up.
So you're bullish on Bitcoin, you're bullish on gold. What about the S&P? It's up 20%, give or take, on the year, and it's trading around 5,700. Do you see that continuing to move higher as we go into year end and into 2025?
Yeah, broadly, I think that there's no case for saying the market could come back significantly. I mean, barring shocks, those could be geopolitical shocks or whatever. I mean, who knows what happens ahead of the election? Who knows what happens in Ukraine or Israel? I mean, these are clearly issues which may spook the market near term. But I think in the longer term, one's got to say that it's a bit like driving a car. If you've got a lot of gas in the tank, you can keep driving, and that gas is liquidity. And if the central banks and banks are starting to pour more and more liquidity into the system, you can keep driving that car for a long time yet. So I still think it goes up. My warning is that maybe by the end of 2025, you are going to see a peak in that liquidity cycle for the reasons that I cited. What's more, one's got to recognize that we've already done a lot of miles so far over the last 2 years in terms of asset market gains or risk asset market gains. So it's not it's not a slam dunk here, but the fact is that you've got to think about the medium term, and in the medium term, we are getting a lot of monetary inflation. Politicians are going to kick the can down the road and increasingly fund at the short end of the market. And, as I've said before, I mean, someone is fiddling the cards here, and it's, the Fed and the Treasury. And we've got to start investing against them and start thinking more and more about diversifying out of monetary, out of or into assets which are dedicated monetary inflation hedges. Things like gold really stand out over the medium term. Prime residential real estate is always a good asset to own. I did a call on an Australian program today about these very same things, and the commentator made the point that actually in Australia, prime residential real estate is absolutely going through the roof because people are sensing there's monetary inflation there. And these are the sort of things you'd start thinking about. Prime residential real estate, the gold prices are at an all-time high. You're looking at Bitcoin, which is close to that. All these monetary inflation hedges are doing pretty well. And that's what you've got to start thinking about. Stick with equities. Good quality equities will do well in a moderate inflation. What tends to wreck the equity market is either a deflation or a very high inflationary period. And I don't really envision either of those two in the near future.
Michael, I always like discussing possible black swan events. All right. And you have said in the past that all financial disasters are brought on by the inability to refinance debt. And when you look out maybe a year from now, 2 years from now, does this become that black swan event where we get a serious collapse in financial markets because of this inability to service and refinance debt?
Well, let's never say never, because I think that if you look back from experience, every financial crisis that I can recall has been a debt refinancing crisis, and we haven't cured the cycle yet. There's still a cycle, and as I alluded to, if you look at the path of debt, it's exponential, and if you look at the path of liquidity, it's cyclical. So inevitably, there's going to be a disaster when there's a shortfall between liquidity and the needs of debt refinancing. One hopes that the policymakers understand that.
And Michael, what about China as a potential black swan event? Maybe things are significantly worse there than we're aware of. Do you think China is currently imploding?
I don't think China's imploding, but I mean, the sort of reality is that the Chinese financial system is pretty basic and very straightforward. It's nothing like as complex as the Western financial system. So I think if you're looking at a financial unraveling, it's more likely to come from the West rather than in China. But that doesn't mean to say that China doesn't have problems. China's problems are much more industrial, and they're much more about developing the financial system more and actually getting off the dollar hook. That's what they need to do. And as I wrote in a book called Capital Wars a few years ago, the great problem China has is getting off the dollar hook, and that's not an easy task. So China's struggling on, and a lot of the travails of China that we've seen over the last few years have really been about this whole problem. The fact is that her industrial economy is massively overdeveloped relative to her financial sector. In the case of the West, it's kind of the other way around, is that the financial economy is vastly greater than the industrial economy. And if you look at the financial economy in the West, the real question to ask is, will there be another crash like 2008-9, or maybe even like the Asian crisis in 1996-97? Those crises will recur because they're debt refinancing crises.
Well, Michael, that was a fascinating discussion. I want to thank you very much for spending time with us today. If somebody would like to follow you online and learn more about your research, where can they go?
Best way is Substack. Our Substack is called Capital Wars. That's named after a book I wrote about 5 years ago with the same title about global liquidity. The institutional service is available on www.crossbordercapital.com, and there's Twitter with the handle @CrossBorderCap.
That's great. Once again, Michael, thank you.
Been a great pleasure, James. Thank you.